Out of the entire financial model, building a cash flow statement is a very challenging part, and that is where most of the people fail. In this video, we are going to build the entire cash flow statement, where initially we are going to understand the elements of cash flow statement and then build the entire practical version using our case study. A lot of you have downloaded templates for the previous modules and worked alongside with us building your entire financial model. You can download for this module as well. The link is in the description. After this module, you will have the entire financial model with you, which you can showcase as a project in your resume as well. So hello everyone, my name is Karan Damania. I am an ex-investment banker turned founder, and through Encoding Careers, we help you build successful career in finance. So let's get onto the screen and understand about cash flow statement. Okay, so we are at module number 5, that is Introduction to Cash Flow Statement. Initially, we will understand the elements of cash flow, and then we will be moving on to modeling the entire cash flow for the current year. So here we are going to cover what is cash flow statement, why is it important, how does it work. Then there are three elements of cash flow statement, that is CFO, CFF, CFI. We are going to understand each of the element in detail, what is its meaning and how can it be calculated. And finally, we will be understanding about net cash flow, how is it calculated, and then what is transferred to the balance sheet. So let's get started with understanding about cash flow. Okay, so here we have point number 1, what is it? So a cash flow statement is a record of actual cash movement in and out of the business during a time period. So in the previous modules, we had modeled out P&L and balance sheet, where P&L helped us understand about the operation of the entire business, how is the business making money through its operation, and balance sheet helped us understand the position of the company based on its asset and the liabilities that the company had. So when P&L and balance sheet were created, they were based on accrual method. That is, when the company is doing business, whenever it makes revenue, it is recorded in the books as soon as it is generated, and not when the money is earned. So the profits that you get at the end of the year, it includes the element of revenue which is not yet earned, right? So that does not give an entire clear picture of what is the movement in the cash. That's why a cash flow statement is created, where it helps us understand the real movement in cash which is going in and out in the business, and that too during a period of time. So as all the financial statements are created for 1 year period, that is starting on 1st April and ending on 31st March of the next year, which gives us a 1 year period. So the cash flow statement will also be created for that period. In short, cash flow will help you understand the real cash movement in the company and not just the recorded ones. In the end, the balance that you get in the cash flow statement will match the cash balance in your bank account. That is the main purpose of cash flow statement. Now, why is it important? Here we understand point number 1. It tracks liquidity, not just profit. As we mentioned in the earlier points, that the P&L statement will give you profits, which are not the real cash in the company, and cash flow statement will help you understand the real cash in the company, which is the real liquidity in the business. Next point, it reveals if the company can meet its obligation and fund its growth. Since cash is most important whenever you are doing business, you have to make sure that you have enough liquidity in your bank, so that if you are having some vendors, right, so you need to pay them, and that cash balance can be used for meeting all the obligations. You cannot all the time pay the vendor on delays and keep on adding to your payables. You need to have cash in your bank account so that you meet all the obligation. And next point, to expand your business, you need funds. That funds will also be coming from the cash balances that you have in your bank account. And the final point is often more reliable than P&L for evaluating financial health. Now, as we know that P&L will be showing balances which are on the accrual basis, that is, it is not earned on the actual time. And cash flow statement is showing all the balances that is real time in bank account. That's why it becomes a more reliable source than the P&L statement. So when we will model out the entire cash flow statement for current year, you will understand these points in more detail. Coming on to the third part, which is how does cash flow statement work. The point here mentions that it is divided into three parts. Number 1 is operating activities, which is the core business cash, which is generated from running the business. Next element is investing activities, which means buying or selling of assets, right? And the final element of the cash flow statement is financing activities, which includes loan, equity, and repayment. In short, cash flow covers the entire business activities, starting from the operation of the business, going into its investing, and finally what are the financing source that the business has used. That way, understanding a cash flow statement will give you a clear picture of what is going on in the business in real time, and not on the accrual basis. It is important to assess on the accrual basis as well, because not all the businesses will run on the spot cash elements. You have to make sure that you are assessing a company taking into consideration all the three financial statements. The final outcome of analyzing a cash flow statement or building a cash flow statement will help you understand where is the cash coming from and where is it going. Most businesses face challenge that they don't have a track of what is happening in the company in regards to the cash. Building a cash flow statement will help you understand where did the actual cash go out in the business, and you can tally it using your bank account balance as well. That is a brief about cash flow statement, where we understood what is it, why is it important, and finally how does it work. Over here in the how does it work part, as we can see that we have three elements of the cash flow statement, that is operating, investing, and financing. These are the core elements of cash flow statement, where operating is termed as CFO, that is cash flow from operating activities. Next is CFI, which is cash flow from investing activities, and finally we have CFF, which is cash flow from financing activities. Next, we are going to understand all these three elements in detail, and we will see what goes into each of the element. Starting with CFO, we have detailed explanation of how it works and how is it calculated. So initially we have formula for CFO, which is net profit plus non-cash expenses, and finally minus working capital changes. Whenever you build a cash flow statement, the thing that you need to keep in mind is the entire elements of cash flow statement will be coming from P&L and the balance sheet, because that is portraying the entire picture of what the business is doing based on the accrual method, and now you have to convert it to cash basis. The first element of cash flow from operation is net profit, which is coming from P&L statement, which we have already calculated. Now in this you are adding back the non-cash expenses, which is your depreciation and amortization. As the name over here suggests that it is non-cash expense, that is you have not spent money for that particular expense when you are doing your business. When you are calculating your profits, you subtract this non-cash expense from it, that is your depreciation, and your amortization is subtracted from it. But now you need to add it back so that it will reflect a real cash profit in your business. So let's assume that you had profit of 100, you had 10 rupee depreciation and 10 rupee amortization. Your net profits was 80 for you. Now that you have added it back, so cash flow from operations will now be 80 plus this now non-cash expense, which is 10 plus 10, where it again becomes 100, and then you will subtract working capital changes from it. Coming to working capital, it includes three elements. Number one is accounts receivable, then we have accounts payable, and finally we have inventory of the business, right? So here we have to calculate the changes that has occurred in all the three elements. Over here changes means that we have to calculate the addition or reduction in the three elements of working capital based on the previous year. So for example, we had 100 rupees of accounts receivable in year 1, and in the year 2, which is the current year, our accounts receivable increased to 120. We have to now calculate the changes that has happened in accounts receivable for the current year, which is it has increased from 100 to 120. That is, it is increased by 20 rupees. So that 20 rupees will be working capital changes for us in the accounts receivable segment. So that way we got 20 rupees as accounts receivable. Now let's assume that payable increased by 30 rupees and inventory increased by 40 rupees. So for us, we have to calculate the total of the working capital change. Now the formula to calculate total working capital changes is increase in accounts payable minus increase in accounts receivable minus increase in inventory. So for us, as we have taken this example, it will be 20 minus 30 minus 40. So our net working capital changes will be minus 70 plus 20, that is minus 50. So we will now subtract minus 50 from the entire cash flow from operation calculation. So as we had net profit of 80, we added 20 back to it, and as we are subtracting 50, our CFO will now become 80 plus 20, that is 100, minus 50, that is 50. So over here 50 means that the entire business had generated 50 rupees in cash balance that was reflected in our bank account. Now let's go through each of the point that we have mentioned over here. CFO captures the cash generated or used from the company's core business operation. In the above example that we had calculated just now, we understood that how much is the core cash generation from the business operation, which is reflected in the bank account. and it does not take into consideration the accrual basis of calculating revenue and expenses. It reflects how much real cash the business makes from selling its product or services. So for this point, we have to understand about working capital changes. How is it real cash, right? So when we calculated the changes in working capital, we subtracted increase in account receivable, we added increase in accounts payable, and finally we subtracted increase in inventory. Now to understand this, whenever we are adding something to receivable, that amount is not yet accounted into our bank balance, and that's why to nullify its effect, we are then subtracting it from the entire cash that we generated. Talking about accounts payable, whenever there are business expenses that we are making, and some of the expenses are on equal basis, that is we need to pay them, but we have already showed it in our expenses, so that will be cash addition to us because we have already subtracted it, and that expense is not paid. We are now adding back the cash that we had left for that expense, and that is showed as accounts payable. And the final element is increase in inventory. Now whenever you are adding more inventory to your business, that is you had 50 in the last year, now you have 100, you have added more 50 to it, and that 50 is not yet realized into the business as sale. So for that you have to hold that 50 in your business, and whenever that money is hold into your business, you had a cash outflow, that is your cash has gone out but it is not yet received in terms of sale. So that's why you are subtracting the increase in inventory. And when you get all the increase or reduction in the following elements of working capital changes, you then calculate the total of it, and that goes to working capital changes, which helps us understand the real cash that the business has made from selling its product and services, irrespective of the payables, receivables, and holding of inventory amount. The third point over here is positive CFO is equals to healthy self-sustaining business. When we saw the previous example, we had a positive cash flow from operation of 50 rupees. That means that we are running positive cash flow, which is good sign for the business as it can sustain on its own, and it does not need extra money from the outside to finance the business. Now in the opposite case, if we had gotten negative cash flow from operation, that is we had lot of accounts receivable, they have increased from 100 to 200. That way the increase in accounts receivable would be 100, and then we would have a negative cash flow from operation, that which would signal that we are not running effectively, and there is some problem in the business operations efficiency, which would indicate that we have to focus more on reducing receivable part and then adding more revenue in the cash basis. So that way cash flow from operations will give you a picture of what is happening in the operation of the business. And the final point is adjustments are made for non-cash items like depreciation and working capital changes. So this we saw using the following above formula. Next, we are moving to second element, that is CFI, which is cash flow from investing. Here from the term itself, we can understand that it is cash flow from investing. And whenever we invest into something, that becomes our asset. So all the elements of cash flow from investing will be related to asset. So over here, we can see the formula, that is sale of assets minus purchase of assets, which is very simple to understand. Whenever you are spending money towards buying a asset, it is a cash outflow. You have given money to the vendor from whom you are buying the asset. And whenever you are selling your asset, for an example, you had a television set at your office in the business. Now you don't want that television set, you want to discard it. You will go to a vendor, you will give the old television to them, and you will receive money for that. Now that is sale of asset. If you would have received 1000 rupees for the entire set, then that will be cash addition into the business. 1000 rupees is being credited into your bank account, and that is a cash inflow. In the similar manner, if you are buying a TV set for your business, it is a cash outflow. You have given 1000 rupees to the vendor to purchase the asset, and that will be a cash outflow, and that is why it is subtracted from the business. Whenever you receive cash, you add your cash flow. Whenever you are paying cash, you reduce your cash flow. Now let's go through the points. Point number one, this includes cash spent on or received from investment in assets such as property, equipment, stock, bonds, or acquiring other businesses. So here point number one is saying cash flow from investing is cash spent on or received from investment. That is either you are paying out cash, which is outflow, or you are receiving from it, that is inflow. And that could be from various type of assets such as property. If you are buying a new property or you are selling out your old property, that is related to your business. that will give you an outflow or inflow in the business. Next is any equipment that you have purchased or sold, any stocks or bond that you have as your investment, or you have acquired other business for which you are paying, so that will be cash outflow. If you are selling your business, that will be cash inflow. The next point is negative CFI is not bad. It often means that business is investing in future growth. Okay, this is very important point to understand. Let's take an example for this. Let's assume you are doing a car sharing business for which you need cars. Now let's assume you purchased a 10 lakh rupee car for your business. This is a purchase of asset, and you sold off a old motorbike which gave you 50,000 in your cash balance, where we add 50,000 to our bank account. Now the net cash flow from investing activity is sale of asset minus purchase of asset, that is 50,000 minus 10 lakh amount, which will give us 9.5 lakh. So this will be negative, that is it is spent out of the business. But this 9.5 lakh doesn't mean that we are doing business badly. We have just invested this 9.5 lakh for our future growth. That is, we have taken a 10 lakh rupee car which is going to give us revenue for the next 5 to 10 years of time. And that way, whenever business is reinvesting in their future growth, they will purchase more assets for their business, and that will often mean that the business is reinvesting in its future growth. Next is, this section tells us how the business is reinvesting its profit. That is how the entire business works. You first set up your entire revenue system, you set up the entire operations, you add few assets into the business. Once the entire system is set up, you are now expanding the business, where you are adding more asset, you are setting up operation around that asset, and finally generating revenue through it. And that way you keep on multiplying those assets and multiplying your revenue at the same time. So the first profit that you generated, you added more asset into your business, you generated more profit, you generated more assets, and that's how the cycle goes on. And this CFI will help us understand how the business is reinvesting its profit. That is about cash flow from investing. Final element of the cash flow statement is CFF, that is cash flow from financing. In the previous modules, we have understood that business does not have cash on its own. It has to raise funding from outside to run its business operations. The cash flow from financing element of the statement will help you understand how is the business financed. And we also understood that there are two elements to finance a business. It could be either through debt or it could be through equity, where you are sharing out the portion of your business with the investor. Now, in the cash flow from financing, we have the formula which will help us understand how much financing did the business have in the current year. So, formula is net debt issuance plus net equity issuance, and finally dividend payment. Over here, net means that whatever amount we have repaid for the debt that we had previously will be subtracted from the initial amount that we have taken for a current year. So, for an example, if we had 1000 rupee loan for the previous year, right, year one, and in the current year we are adding 2000 worth of loan, and we are paying 500 worth of previous loan. Now the net amount that we have will be 1500 from this, because we have added 2000, we have subtracted 500 of this previous loan. So 1500 is the net debt issuance for the current year. Equity will be easy. Whatever amount you are raising through stake dilution in the company will be net equity issuance. If you are paying any fees related to that fundraising, you will subtract that from the entire equity issuance amount and write the amount over here as net equity issuance. And finally, if you are paying out money to your investors in form of dividend for investing into your company, you will subtract that amount because it is cash outflow for the business. In the previous two elements of the CFF, we saw that the business was getting money into it. That is, we saw that 2000 was coming into the business, out of which we are only paying 500. So 1500 is still coming into the business. That is why it is added. Next is equity issuance, where we saw that we are diluting stake and raising funds, where business will get funds from the investor. So that once again we are adding it. And finally, when we are paying out dividend, we are subtracting it because it is cash outflow to the investors. That is about the formula of CFF. Let's get on to the points. CFF shows the inflow and outflow of cash related to funding of the business. This we understood initial point only, that business does not have cash on its own and it needs funding from the outside, and it can do it through issuing shares, taking loans, repaying debt, and paying out dividends. So these are all the elements of CFF. Next point, it tells us how the company is raising or returning capital to owners and creditors. Here there will be two elements to CFF. Number one is debt, number two is equity. The equity holders of the company are said to be owners because they have equity shares in the company and they have ownership rights. On the other hand, creditors do not have shareholding in the company and they have a liability outstanding on the balance sheet where we have to compulsorily pay out our creditors. And on the ownership side, we don't have a compulsory mandate to pay out the investors. The cash flow will help us understand how are we raising funds. Is it through equity or debt, and how are we paying back to the owners? Owners will be paid in terms of dividend, creditors will be paid in terms of debt repayment or interest element. The final point is this helps evaluate the financial strategy and leverage of the firm. We can understand from CFF that is the company too much on leverage, that is it has raised too much debt, or we can go for more debt so that business can expand in smooth manner. We can also understand if the business is funded on less equity so that we can raise more equity and get in balance with the leverage that business has. That is a decision you can make using CFF. Next, we will understand the final element of cash flow statement, that is net cash flow, which will help us understand what is the amount of cash that business has generated, and this cash element will go into the balance sheet as our year ending cash balance. The formula for this is very simple. You add all the three elements, which is cash flow from operation, which is cash flow from investing, and finally cash flow from financing. Most of the businesses will have a positive cash flow from operation, they will have a negative cash flow from investing, and finally the CFF will be positive because business keeps on getting money from the outside investor to run and expand its business line. That is what you have to keep in mind when you are analyzing business or working on one. Going through the points, net cash flow is the total change in company's cash position over a period. So for us, it will be 1 year. What is the change in the cash of a business in the 1 year period time? It is calculated adding the cash flow from operation, investing, and financing activities, which we saw using this formula. A positive net cash flow means company's cash balance increased, a good sign of financial stability. Easy point to understand that if the cash balance is increasing, that is company is making more money and it is sustaining on its own, and we understand that the business is stable and doing good in the market. And the final point is this figure helps assess whether the business is generating or burning cash overall regardless of profit. So a lot of time it would happen that your positives are increasing on a every year basis, but it could be that your cash balance is reducing because you are doing a lot of investing activities. Your business would be on revenue receivable basis where it is not receiving money from the debtors, and it keeps on adding up, which highlights that your business is not running efficiently and you need to take some serious action related to that. That way cash flow will give you a clear picture of what is happening on the operation side, what is happening on the investing side, and how is the business financed through equity or debt. Now let's get on to our Excel and model out the first year cash flow statement for our case study. Okay, so we are building cash flow statement using this template. Before we start plugging in data, we know that cash flow is built using balance sheet and P&L. So we will mark out each and every line item of balance sheet and P&L which is going to be entered into cash flow statement. We are going to start it with P&L statement. When we went through the presentation, we came to know that the elements that are contributing to cash flow statement are net profit, which goes into cash flow from operation. Then we have depreciation, and finally we have interest element, which we will now see how it affects the entire cash flow statement. So we are going to mark each of those. The first element we have is depreciation, which goes into cash flow from operation. It also affects cash flow from investing activities. Next, we have interest expense, which will affect cash flow from operation, and it will affect the cash flow from financing, that is CFF. So we are writing all these short names for each of the element of cash flow statement. And finally, tax is definitely a cash outflow, which we have already subtracted from net profit. So we are going to take over here net profit, which will go into cash flow from operations. Now we have calculation for revenue and OPEX, which are the supplementing sheets which we don't take to cash flow statement. Next we come to balance sheet, and we will now mark each of the element of balance sheet of what will go into cash flow statement. Starting with non-current asset, these goes into cash flow from investing. Furniture will go into cash flow from investing. Next we have cash in bank, which we are going to calculate through cash flow statement. There is no entry for cash in the cash flow statement. Next, we have receivable from clients, which we will add to cash flow from operation. Next is inventory, which goes into CFO. Next, we have long-term bank loan, which is definitely CFF, as it is funding activity for the business. Next we have vendor payables, salary payables, which are both CFO elements as they are part of working capital changes. Finally, we come to equity where we have share capital, which is CFF, as we have raised equity. Finally, we have retained earnings, which we are not going to take to cash flow statement as we have already accounted for net profit. If you can see, the retained earnings is same as PNL. We can see PNL C19, which is the net profit for us. If we add that to CFO once again, then there will be a double entry and the balances will be misaligned. Now we will start plugging in each and every line item into the cash flow statement based on three elements, that is CFO, CFF and CFI. This is the template that we are using. Initially, we will start with cash flow from operations, CFO, right? We will go as per the formula. So for that, we have this. We saw that CFO is equal to net profit plus non-cash expense minus working capital changes. So we will start plugging in from net profit. This will be net profit after tax, and this will be the amount for that, which is 341,600. Perfect. Now we have to add non-cash expenses, that is the depreciation and amortization and the interest expense. We are adding interest expense over here because as per accounting standards, interest is an element of financing activities which we are paying toward the debt that we have taken for the business. So we are going to add it in the cash flow from operation, where we are trying to express that it is not a business operation activity, right? That's why we are adding it back. And in the financing activity, where we are paying out interest to the creditors, we are going to then subtract it. So overall interest is a nil activity in the cash flow statement, but just for the accounting standards you have to present it in the manner where it is as per rules and regulation. So here we will add the interest element and the depreciation. So add depreciation, add interest. Okay, so we are going to plug in the numbers from P&L statement. We have this negative, so we are going to make this positive by giving a negative sign, and interest will also be positive 15,000. Perfect. So we have added depreciation and interest back to the profits. And finally, we have to subtract the working capital changes. Now, working capital, we saw that it had three elements. First is accounts receivable, then we have accounts payable, and finally inventory. So we will take all of these three elements from the balance sheet. This will be changes in working capital. Perfect. So we have three elements for this, and each of this will could be increase or decrease. If the asset is increasing, then it is a cash outflow. If the asset is decreasing, then it is a cash inflow. Similarly, on the liability side, if the liability is increasing, then it is a cash inflow because we have raised fund and it is positive for us. On the other hand, if the liability is decreasing, we are paying out money, that will be a cash outflow. So here we have increase or decrease. Now it could be in accounts receivable. Similarly, we are pasting it for accounts payable and finally inventory. Right. So here we will start with accounts receivable first. So as this is the first year, all the amounts that you are going to plug in will be changes for the current year. As we don't have the previous year, we have no numbers that we can subtract it from. So if the accounts receivable is minus 100 for the current year, it will be same as increase in the accounts receivable as 100 amount, and we don't have to subtract it from the previous year. So whatever we have, if the asset is increasing, we are going to subtract it, and if the liability is increasing, we are going to add it. So let's see what we have in the balance sheet. So first we are going to look for accounts receivable. We have 20,000 of receivables with us, which is increase in the asset, which means that we have to put it as a negative sign. So this will be minus 20,000. Next we have increase or decrease in accounts payable. So when we see balance sheet, we have 20,000 increase in liability, which means that we have to add it back to the balance working capital changes. So this will be sum of these two, that is 20,000 added. And finally we have inventory, where we have to see that is the inventory increasing or decreasing. We have the amount of 10,000 on the positive side, that means inventory is increasing, and we have to put it as a cash outflow. So this will be negative 10,000. So that way we now calculate the total of cash flow from operations. So total CFO. This will be sum of all the above. We have 3,64,600 as CFO with us. Now let's move on to second element, which is cash flow from investing. which is CFI. Let's see the formula for this and then we can calculate. So cash flow from investing is equals to sale of asset minus purchase of asset. That is, if the asset is increasing, we are spending money on buying the asset, and that will be a cash outflow. And whenever we are selling out asset, we are receiving money for the business. For the company that we have taken, we have only purchased asset, which is the in sandwich grill and the furniture. We have not sold any asset in the current year, and that is why it will be all cash outflow for the business. When we are taking asset into our cash flow from investing activities, we need to take the entire asset for which we have paid the purchase price. Now the asset that we record in the balance sheet, it is net of the depreciation, which we can see over here easily, that we have taken 90,000 as the value of sandwich grill. But initially when we purchased it, it was 1 lakh rupees, right? So we have to take this 1 lakh rupees and then add back the depreciation amount to it, which will give us a total cash outflow of 1 lakh rupees. So let's see how we can model that out. So the first element that we have is purchase of grill, and the second element is purchase of furniture. Now to calculate the purchase of grill, we directly have the amount in our fixed asset schedule, that is of the entire 1 lakh amount. If we do not have a fixed asset schedule with us, then this amount would be negative 90,000, which we have in the balance sheet as the non-current asset. We would have then subtracted the depreciation amount from it. So this becomes minus 90,000 minus the 10,000 amount of depreciation charged on sandwich grid. So that becomes 1 lakh. But since we already have the fixed asset schedule with us, we will directly take the amounts from there. So this will be equals to 1 lakh rupees of purchase of grill. Now this is negative amount, so we are going to give a negative sign. And then we have purchase of furniture, which is similarly taken from fixed asset schedule, that is negative 40,000, which is paid towards purchase of grill and furniture. So total of CFI, this is total CFI, which is sum of these two, negative 1,40,000. So when we understand CFO, it helps us understand that when Sandy completed his 1 year of business, he had done a profit of 3,41,600 in his books of account. But he had 3,64,600 as cash flow from operation. That is just running his entire business. He made 3,64,600 in his bank balance, because over here we had subtracted depreciation from the profits. We had subtracted the interest element, which is not paid on the operation side, right? Depreciation is just a non-cash expense where we are expensing out the asset for a period of time. That does not reflect our originality of what is the bank balance. So that way we understand that cash flow from operation was made at 364,600. And from CFI we can see that the investing activity which Sandy did, he purchased 1 lakh worth of grill and 40,000 worth of furniture. So that way he spent 1,40,000 from his bank balance and purchase these assets. Now final element of cash flow statement will be cash flow from financing. So we are going to calculate that now, which is CFF. So let's first understand the formula and we can then calculate that. So the formula for CFF is net debt issuance plus net equity issuance minus the dividend payment. So talking about our example over here, we have a debt that we have taken from bank, which can be net debt issuance. We do not have any processing fees or anything we have mentioned in the case study, and we only have the entire debt amount with us. On the equity side, initially Sandy invested 50,000 into the company, and it is non-interest based. He took ownership of the company, paying 50,000 into the business. So that way we have two amounts with us, on the debt side, on the equity side. There was no dividend that was paid back to Sandy, as he is the sole owner right now. Over here, we only need to focus on the debt and the equity issuance element. Coming back to the model, we will plug in the numbers. So cash flow from financing will include the share capital, which is the equity element. Next, we have the debt issuance, which is debt part of financing. So on the share capital side, we can see from the balance sheet that we had raised 50,000 in share capital, which is positive for us as cash is coming into the business. And on the debt part, we will now see in the borrowing schedule how much is the total amount of debt that we raise. So going to the borrowing schedule in the balance sheet, we will see that we have 1 lakh amount of debt that we raised through a bank, right? So we will plug in this 1 lakh amount, as it is a positive cash flow for us, it has positive sign. And finally on this debt amount, we paid a 15,000 worth of interest. So as we saw that we had to add interest in the cash flow from operation element, we now need to subtract the interest element from the CFF. So here we will take the same element, we will paste it, but now this will be subtract or less. So this will be taken from the PNL 15,000. Perfect. So now we have 50,000 funds that we raised from Sandy. Sandy also took a loan of 1 lakh from the bank. So that way 1,50,000 was added into the business initially, and on this 15,000 worth of interest was paid back to the bank. So that has to be subtracted from cash flow from financing. Now we will sum this up and we will get a 1,35,000 positive cash flow that we got from financing. So this is total CFF. Perfect. Now we have calculated the three elements of entire cash flow statement. We need to calculate the closing balance that we will take to balance sheet, which will help us tally both assets and the liabilities. We can see that there is a check of 3,59,000, which is a difference between the total liability and the total assets, which should match. But for now, we are getting a reference error. So this is the amount that cash flow should give us. And if it is not that, then we have made some error in calculating cash flow. Let's see what is the total that we get. So we transfer the closing balance of cash. Now to calculate closing balance, we need to calculate the opening balance plus the net cash flow. So opening balance for us is zero, as we had started business from scratch. There was no previous year cash that came into the business. Now first year cash that we now calculate will be opening balance of the next year. So since this is the first year, we don't have the opening balance. To calculate net cash flow, let's look at the formula. So net cash flow is equals to simply CFO plus CFF plus CFI. So going back to the model, let's sum it up. This will be CFO plus CFI plus CFF. That way we get 3,59,600. Now closing balance is sum of these two, that is opening plus the net cash flow. Now let's take this to the balance sheet and see if the assets and liability get tallied. So coming back to the balance sheet, we will plug in this from cash flow, which is 359,600, and let's go. We have the balance sheet tallied with us. The total assets are 5,11,600 and the total liabilities match at the same amount, and we have no reference check, that is this is zero. So that is how we calculated the entire cash flow statement, taking into consideration three elements, that is CFO, CFI and CFF, understanding each element into detail. Alright, so we have completed the first part of cash flow statement, where we understood the elements of cash flow statement and then modeled it out for the current year using our case study. In the next part, we are going to model out the cash flow statement for the next 3 years, and that will help us to tally our balance sheet and close out on the financial model. So that is it for this video. See you in the next one. Until then, this is Karan Damania taking your leave.